California's median home price is projected to reach around $95,000 by 2026, marking yet another record-breaking milestone. It feels like with every passing year, almost every few seconds, we're setting a new high. But there's a side of the story that isn't getting much attention. Hidden behind those headline-grabbing numbers, there are actually cities across the state where prices are moving in the exact opposite direction. In many of these areas, sellers are cutting their asking prices just to attract interest. Homes are lingering on the market for months at a time without selling. Listings keep stacking up, yet buyers seem to be nowhere in sight. This isn't some distant forecast or speculation about the future. It's already unfolding. Right now, in 2026, this shift is happening in real time. And when you break things down city by city instead of relying on statewide averages, the reality looks very different from what the headlines suggest. In this video, we're going to count down 10 cities in California where home prices are currently dropping fast. If you already own property in one of these locations, this is something you'll want to pay close attention to. And if you're considering buying a home, it's even more important that you stick around for this. Let's dive in. Fresno ranks as the fifth largest city in California, with a population that's climbed past 500,000 residents. For years, it's been considered one of the more budget-friendly major cities in the state, which gave it a strong advantage. As coastal housing became too expensive, many buyers headed inland, and Fresno saw steady growth because of it. But at the moment, there are clear signs that the housing market is starting to weaken. More than 20% of the homes currently listed in Fresno have already gone through price reductions. That means roughly 1 out of every 5 sellers is lowering their asking price after failing to attract buyers at the original figure. At the same time, home value growth has cooled to about 2.4% year over year. That might seem acceptable on the surface, but with inflation hovering around 3%, the reality looks different. In practical terms, that means home values in Fresno are actually declining when adjusted for inflation. On top of that, properties appear to be overvalued by nearly 12%, suggesting prices are outpacing what the local economy can realistically sustain. When you compare a median household income of about $64,000 to a median home price approaching $380,000, the numbers start to feel stretched. Buyers can only push their budget so far before something has to give. And in Fresno, that breaking point seems to be happening right now. The Central Valley faces a particular challenge in this regard. While it draws in buyers looking for lower prices than the coast, the reality on the ground can be less appealing. Job opportunities are relatively limited once people arrive. The summers are intensely hot, and the region struggles with some of the worst air quality in the nation. As a result, some residents decide to leave, while others simply stop moving there altogether. Meanwhile, sellers who purchased homes at peak pandemic prices are realizing that the level of demand they expected has faded. Fresno isn't in a full-blown collapse, but the days of listing a home and receiving multiple offers within days are largely gone. If you're trying to sell in Fresno today, you're facing a smaller and more cautious group of buyers. And in most cases, that reality forces sellers to lower their prices to stay competitive. Bakersfield is following a path that looks a lot like Fresno's, but with a few added complications layered in. Right now, about 22.5% of homes on the market in Bakersfield have already seen price cuts. That works out to nearly 1 in every 4 listings being reduced just to stay competitive. The overvaluation issue is even more pronounced here, sitting at roughly 19.4%, which is noticeably higher than Fresno. In other words, home prices in Bakersfield are hovering close to 20%, above what local incomes and economic fundamentals can realistically support. For a city where the typical household earns around $63,000 a year, that affordability gap keeps stretching wider month after month. During the pandemic housing surge, Bakersfield was actually one of the standout winners. Buyers poured in from places like Los Angeles, drawn by the promise of cheaper homes and more space. As demand surged, prices climbed quickly. Investors jumped in to scoop up properties, and new developments expanded at a rapid pace. But now that the frenzy has cooled off, the situation looks very different. Bakersfield is left with a growing number of homes that simply aren't selling at those inflated pandemic-era prices. On top of that, the local economy introduces another layer of uncertainty. The oil industry, which has long been a major pillar of Kern County, is facing an uncertain future. With California continuing to push policies aimed at reducing fossil fuel use, the industry is under increasing pressure. Each new round of legislation chips away at its long-term stability. As a result, workers tied to oil production are becoming less confident about their future job security. That kind of uncertainty plays a big role in whether people feel comfortable buying a home in the area. When you combine weakening demand, overpriced listings, a buildup of inventory, and an economy tied to an industry in decline, the outcome is pretty clear. The housing market in Bakersfield is adjusting, and not in an upward direction. It's not a dramatic collapse, but it is a steady downward slide. If you purchased a home here at the peak in 2021 or 2022, there's a good chance your equity isn't as strong as you might expect. And honestly, it may be shrinking faster than your patience if you've been watching this without subscribing. So go ahead, hit that button. Your home equity might be dipping, but this channel is still on the rise. Modesto is now ranking among the top 3 cities in California when it comes to price reductions. The share of listings with lowered asking prices places Modesto right up there with Stockton and Riverside as some of the most heavily discounted markets in the state. On paper, home values have shown slight growth. But once you factor in inflation and compare current prices to their peak levels, the picture becomes less encouraging. A significant number of homeowners are either underwater or getting uncomfortably close to that point. Historically, Modesto has been a go-to destination for people priced out of the San Francisco Bay Area. Located roughly 90 minutes east of San Francisco, it used to be a manageable commute for those willing to make the drive. For a long time, that proximity worked in its favor. But the shift toward remote work ended up changing that dynamic. Many buyers who relocated to Modesto during the pandemic to save money while working Bay Area tech jobs have since been called back into the office. Some chose to move closer to their workplaces again. Others decided to leave California altogether. Either way, the wave of demand that once supported Modesto's housing market has clearly weakened. On top of that, the city has been dealing with a recurring car theft issue that has made national headlines more than once. Property crime levels remain significantly higher than the state average. These aren't just abstract numbers. They directly influence how people feel about buying property here. After all, few buyers are eager to invest hundreds of thousands of dollars in a city known for having one of the highest car theft rates in the country. Meanwhile, housing inventory continues to climb. Homes are sitting on the market longer than they used to. Sellers who initially priced their properties aggressively are now returning with noticeable reductions, often cutting $5,000, $10,000, or even $15,000 to attract interest. At this point, Modesto has clearly shifted into a buyer's market. For sellers, though, that shift brings a much tougher reality. And for homeowners who bought during the height of the market, watching nearby properties drop in price is far from reassuring. Riverside stands as the largest city in the Inland Empire, with a population hovering around 315,000 residents. For a long stretch, it was considered one of the most active and desirable housing markets in Southern California. The appeal was easy to understand. You get classic Southern California weather, you're roughly an hour from Los Angeles, about the same distance from the beach, and home prices were significantly lower than coastal areas. That combination drew in buyers quickly. Investors piled in even more aggressively, and during the pandemic, prices surged at a rapid pace. But now, that momentum has clearly shifted, and the correction phase has begun. By the end of 2025, the Inland Empire recorded a year-over-year price decline of about 2.5%. At the same time, nearly 24% of homes listed in Riverside have undergone price reductions. That's close to 1 out of every 4 sellers acknowledging their original price was too ambitious. The overvaluation rate currently sits at around 18.5%, paired with a price-to-income ratio of 6.4. In practical terms, that means the average home costs about 6.5 times the median local income. Traditionally, a balanced and sustainable ratio falls somewhere between 3 and 4. Riverside is operating at nearly double that level. The core issue is that the Inland Empire was built on the idea of affordability. Once prices climbed too high, that entire advantage started to fall apart. It becomes much harder to justify a 90-minute commute from Riverside to Los Angeles when housing costs begin to approach those in parts of LA itself. At that point, the numbers simply stop making sense for many buyers. Another growing concern is the rising cost of insurance. Certain areas within Riverside County fall into high wildfire risk zones. As a result, insurance premiums have been increasing, and in some cases, providers have even withdrawn coverage from specific zip codes. When your monthly mortgage jumps because insurance costs suddenly double, the home no longer feels as affordable as it once did. To be clear, the Inland Empire isn't headed for a total collapse. There's still underlying demand. However, the era of intense bidding wars and homes selling within a few days is largely behind us in Riverside. What we're seeing now is a market that overheated and is gradually settling back to more realistic levels. And if you've made it this far watching a breakdown of falling home prices on an otherwise normal day, you and I are probably wired the same way. Go ahead and subscribe. The top 5 cities on this list are on a whole different level. Sacramento serves as the capital of California. The city itself has a population exceeding 500,000, while the broader metro area is home to more than 2 million people. It's also one of just 3 housing markets in the state that Realtor.com expects will see price declines of at least 3.3% in 2026. That projection places Sacramento among the most notable declining markets, not only in California but across the entire country. During the pandemic, Sacramento experienced a massive surge in demand. It quickly became the top destination for remote workers leaving the San Francisco Bay Area in search of more space and better affordability. Many buyers were selling condos in San Francisco for around $1 million, then purchasing larger 4-bedroom homes in Sacramento for roughly half that price, and still having money left over. That wave of incoming buyers pushed home prices up at a rapid pace. In fact, the median home price jumped from about $350,000 in 2019 to over $500,000 by 2022. That's roughly a 40% increase in just 3 years. But that surge in demand hasn't lasted. Some employers have required workers to return to the office. Others who initially moved for remote work found Sacramento's intense summer heat difficult to deal with and chose to relocate again. Meanwhile, many of the buyers who stayed are now sitting in homes they purchased at peak prices, watching the market gradually cool. Inventory is climbing, and the number of active listings continues to rise. At the same time, sales activity hasn't kept pace with that increase. Homes are taking longer to sell, with days on market steadily increasing. The condo segment, in particular, is facing more pressure. Downtown Sacramento condos that were once in high demand during the remote work boom are now lingering on the market, often with price reductions, as that buyer pool shrinks. While the presence of state government jobs does provide a relatively stable employment base, it isn't enough to support the elevated prices created during the pandemic surge. Sacramento remains a strong city overall. It offers a vibrant food scene, a growing cultural identity, and still maintains better affordability than many coastal markets. However, home prices climbed too quickly, and now the market is adjusting to a more sustainable level. A projected decline of 3.3% might not sound significant at first glance. But on a $500,000 home, that translates to a loss of more than $16,000 in value in just 1 year. For homeowners carrying high levels of debt, that kind of drop can have a serious financial impact. San Jose sits at the heart of Silicon Valley and ranks as the 3rd largest city in California, with a population exceeding 1 million people. Recently, it recorded one of the sharpest drops in median home prices among major cities nationwide, coming in at a decline of about 5.5%. In a market where the typical home price is above $1.4 million, that kind of percentage drop carries serious weight. A 5.5% decrease translates to roughly $77,000 in lost home value for the average homeowner in just a single year. That's more than what many Americans earn annually, essentially wiped out on paper. The underlying cause isn't complicated, and it's a trend that's been unfolding since around 2020. Remote work fundamentally disrupted the pricing structure that Silicon Valley relied on. For years, the logic was simple. If you wanted to work at companies like Apple, Google, Cisco, or Adobe, you needed to live nearby. That necessity created a proximity premium, which made paying $1.4 million for a modest 3-bedroom home seem justifiable. But the pandemic proved that assumption wrong. Engineers and tech workers began doing their jobs from cities like Austin, Denver, Boise, and Raleigh. While some companies eventually asked employees to return, many adopted hybrid models that only require being in the office a few days each week. That shift has caused people to rethink whether it's worth living in one of the most expensive metro areas in the country. For many, commuting a couple of times a week from a more affordable city suddenly feels like a better deal. On top of that, layoffs in the tech sector added even more pressure. The wave of job cuts that began in late 2022 and stretched through 2023 and 2024 hit the Bay Area especially hard. When high-income tech employees lose their jobs, they either relocate to cheaper regions or pause major purchases like buying a home. Both outcomes reduce demand in the housing market. As inventory builds, sellers are now being forced to compete more aggressively. Homes that once attracted 10 offers above asking price in 2021 are now sitting on the market for weeks, sometimes drawing only one or two offers. Price cuts are no longer unusual. They're becoming expected. Interestingly, the luxury segment of the market is holding up relatively well. Properties priced above $2 million are still selling, largely because ultra-wealthy tech executives aren't facing the same financial pressures. However, the core of the market, the $800,000 to $1.2 million range, is where the biggest slowdown is happening. This is the segment that used to attract first-time buyers and mid-level tech professionals. Now, that competition has largely disappeared. Many of those buyers have stepped away entirely, leaving sellers with listings that the current market simply won't support at previous price levels. Ukiah is a small community with a population of around 16,000, located in Mendocino County, roughly 2 hours of San Francisco. Based on forecast data from Zillow, Ukiah is expected to experience one of the sharpest home price declines in Northern California as we move through 2026. It's not a place that's widely known. Many people haven't even heard of it. The town is quiet and largely agricultural, situated in a wine-producing region just inland from the Mendocino coast. During the pandemic, however, it suddenly caught the attention of buyers from the Bay Area who were searching for more space, privacy, and a slower pace of life. That surge in interest pushed home prices up. Properties that once sold for around $300,000, especially smaller homes on larger lots, quickly jumped into the $450,000 to $500,000 range. But the wave of buyers who drove those increases hasn't been replaced. Ukiah's location, while scenic, is also quite remote. Even without traffic, the drive to San Francisco takes about 2 hours, and often much longer in reality. The local economy is relatively small, with most jobs centered around agriculture, healthcare, and county services. There isn't a major employer drawing in new residents. Amenities are also limited, with fewer options for shopping, dining, and entertainment compared to larger cities. For people looking to escape urban life during the pandemic, that simplicity was appealing. But for those living day-to-day life in 2026, it can feel isolated. Another factor is the decline of the cannabis industry, which was once a significant economic driver in Mendocino County. Legalization, combined with oversupply, has severely impacted growers. Many who once earned strong incomes in the gray market are now struggling, or have exited the business entirely. That shift has had a ripple effect on the local economy. It has reduced the spending power of a group that had quietly been supporting the housing market. There's no denying that Ukiah is a beautiful. Rolling hills, vineyards, and the Russian River flowing through town all contribute to its charm. It truly offers that classic small-town atmosphere. But charm alone doesn't cover mortgage payments, and when demand fades and buyers stop showing up, prices inevitably have to adjust. That adjustment is already underway in Ukiah right now. Stockton comes in at number 3, and the data here is hard to ignore. According to projections from Realtor.com, home prices in Stockton are expected to drop by about 4.1% in 2026. That makes it the steepest projected decline of any metro area in California and the third largest in the entire country. And when you look at what's actually happening on the ground, the situation looks even more concerning. Roughly 25.4% of homes currently listed in Stockton have already gone through price reductions. That's about 1 in every 4 properties, the highest rate anywhere in the state. Stockton's housing market was built on a similar dynamic to places like Modesto and Sacramento. Buyers priced out of the San Francisco Bay Area moved further inland in search of affordability. Since Stockton was one of the most affordable and also one of the farthest out, It attracted buyers who were especially sensitive to price. During the pandemic boom, home values surged from around $300,000 to well over $450,000. Investors jumped into the market aggressively. House flippers would purchase properties, make quick cosmetic upgrades, and then resell them for $50,000 more within a short time. But that strategy no longer works in today's market. Many investors have stepped back, and flippers are now stuck holding properties they can't sell at a profit. At the same time, everyday buyers, who were already stretching their budgets to afford Stockton, are now dealing with mortgage rates above 6%, which is pushing affordability to the breaking point. Stockton also still carries the legacy of its Stockton bankruptcy 2012. Although the city has spent years trying to rebuild its image, that history continues to influence buyer perception. When people are choosing between Stockton and nearby areas like Sacramento or Tracy, concerns about past financial troubles and crime rates often steer them elsewhere. There have been some positive developments. The waterfront has seen investment, and University of the Pacific provides a degree of stability. Even so, those factors aren't enough to offset a market where a quarter of listings are seeing price cuts, and forecasts point to the largest decline in the state. And if you've made it this far, watching city after city breakdown, you're clearly paying attention to where your money goes. Go ahead and subscribe, because the top two on this list are even more eye-opening. San Diego coming in at number 2 is the one that tends to surprise people the most. This is widely viewed as one of the most stable real estate markets in the entire United States. With its strong weather, major military presence, biotech sector, tourism industry, and institutions like UC San Diego, almost everything about the city suggests long-term stability. But the actual housing data tells a different story. San Diego has recorded a median home price decline of about 6.7% according to data from Realtor.com. That places it as the second largest price drop among major metro areas in the entire country. Only Austin saw a steeper decline. A 6.7% drop in a market where the average home is around $750,000 translates to more than $50,000 in lost value. That's essentially a full down payment in many parts of the country, erased on paper. So what actually changed in America's finest city? The biggest issue is affordability hitting a breaking point. Home prices in San Diego climbed so rapidly during the pandemic that they eventually outpaced what most buyers could realistically afford. Even with the region's strong job market and relatively high salaries, the gap between income levels and housing costs became too wide to sustain. Once mortgage rates rose above 6%, monthly payments on a typical home jumped to levels that many potential buyers simply couldn't manage. Insurance costs are also adding pressure. In parts of San Diego County, especially inland areas closer to wildfire-prone zones, insurance premiums have increased significantly. Some homeowners are now paying 2 to 3 times what they were just a few years ago. That extra cost gets folded into the total monthly housing expense, making homes even less affordable and causing buyers to hesitate. The condo market has been hit particularly hard in this environment. Downtown San Diego condos, along with areas like Chula Vista and National City, are seeing longer listing times and more frequent price cuts. Investors who bought condos expecting strong rental returns are discovering that the numbers no longer add up. Between rising mortgage costs, higher HOA fees, and increased insurance premiums, many properties simply don't cash flow anymore. At this point, the equation has broken down. San Diego is not becoming an affordable city. It's still one of the most desirable places to live in the country, but the belief that prices only move in one direction has clearly been challenged. And for anyone who bought near the peak in 2022, that 6.7% decline isn't just a statistic. It represents real equity that has already disappeared from their balance sheet. California City takes the #1 spot on this list, and it's a place most people have never even heard of. And just to be clear, that really is its official name, not a nickname or shorthand. It's located in Kern County, roughly 100 miles north of Los Angeles, deep in the Mojave Desert. Right now, it's experiencing the steepest home price decline in the entire state, with values down about 13.8% year over year, according to Redfin. Homes that were typically selling in around 70 days last year are now taking about 113 days to move, nearly double the time on market. Meanwhile, The median sale price has dropped to roughly $278,000 and continues to trend downward. California City has one of the most unusual development stories in all of California. It was originally planned in the 1950s by a developer who imagined building a major metropolis that could one day rival Los Angeles. To make that vision real, he laid out streets, subdivisions, and infrastructure across roughly 200 square miles of desert. Because of that, California City is now the third largest city in the state by land area, larger even than Bakersfield and Fresno. But the reality on the ground never matched the vision. Much of that land was never developed, leaving long stretches of paved roads that lead to empty lots, street signs, and fire hydrants pointing to nothing at all. It's not unusual to drive for miles and see almost no buildings, just desert and open space. The original development vision simply never came together, and today, the city has a population of only around 14,000 people spread across that massive area. During the pandemic, California City briefly gained attention from investors and remote workers looking for cheap land and low-cost housing. Prices rose as speculation increased, with many buyers hoping future growth would eventually justify their purchases. But that growth never arrived. Now many of those same speculators are trying to sell into a market with very little demand. The city itself has limited infrastructure and services, with only a small number of grocery stores and gas stations. For full-scale amenities, residents often have to travel about 45 minutes south to Lancaster. The local economy relies heavily on nearby institutions like a correctional facility and Edwards Air Force Base. Beyond that, job opportunities are scarce. The environment is also extreme, with summer temperatures regularly exceeding 110 degrees Fahrenheit, constant winds, and a strong sense of isolation. This isn't suburban living, it's remote desert life. A 13.8% price drop in a single year isn't just a small adjustment, it's a full-scale crash. For those who bought in expecting early entry into the next big California boom, the reality has turned out very differently. California City was never on track to become Los Angeles. It was always destined to be what it is today. A vast, sparsely populated desert city with wide, empty streets and a name that suggests far more than it delivers. And that completes the list of 10 California cities where home prices are falling right now. Across the state, from the Central Valley to Silicon Valley to the Mojave Desert, the overall median may still look strong on paper. But underneath those headline numbers are real communities experiencing real price declines and real financial pressure. If you're thinking about buying, timing matters. If you're thinking about selling, conditions are changing quickly. And if you want to stay updated on what's actually happening in California's housing market, subscribing is the easiest way to keep up. Drop a comment and share whether your city made the list. And if you want all the California data in one place, the full guide is linked in the description. We'll see you in the next one.